When analyzing SPY's current chart, we must first contextualize the broader dynamics at play. The index closed below the 10 EMA, which historically serves as a key pivot point for short-term momentum traders. This inability to recapture such a pivotal level warrants caution, as it suggests the prevailing downtrend remains intact, at least for now. However, the narrative doesn't end there. The market is entering the seasonally bullish phase associated with the so-called Santa Claus rally. This period often brings upward momentum fueled by portfolio rebalancing, holiday optimism, and the lack of significant bearish catalysts. With this in mind, the market's failure to close above the 10 EMA today could very well reverse tomorrow with a gap up, a phenomenon not uncommon during this time of year. The interplay between seasonality and technical resistance makes the next session particularly intriguing. If 593.28 holds as support, a test of 605.65 becomes increasingly likely. The significance of this level is twofold. As an upper level of a previous breakdown candle, it attracts technical traders, and as an extension of the ongoing bounce, it represents the next logical area of price discovery. If there's strong momentum, price could overshoot 605.65, potentially testing the zone around 608 to 610, where other fib extensions or pivots may reside. If 593.28 fails as support, the next key level to watch would be 589 to 590, a zone of prior consolidation and Fibonacci overlap. A failure here opens the door for a retest of last week's lows near 578 and 580. Such a move would likely coincide with broader weakness, potentially signaling that sellers are still firmly in control. The inability to hold these levels last week suggests that institutions or larger market participants may still view them as sell zones. However, if SPY can reclaim and hold above them this week, it could signal a material shift in sentiment, potentially leading to a sustained move higher. The fact that 593.28 is holding currently suggests that buyers are defending this level for now, which is a positive sign. But the real test will come as SPY approaches the confluence of resistance at 596 to 605.65. Looking ahead, the 595 to 596 zone, where the 10 and 20 EMAs reside, is the immediate test for bulls. A strong gap over these levels tomorrow would likely trigger further buying as algorithms and retail traders alike pile in. Conversely, should the market falter at these levels again, it could signal a deeper retracement with the potential to retest lower pivots around 587 or even 582. So what's the play? If SPY gaps above 595 tomorrow, a tactical long position targeting the 600 to 605 zone could offer a favorable reward to risk setup. That said, any signs of rejection or weakness near the EMAs should prompt caution. Consider scaling in rather than going all in, as the market's ability to hold those levels will dictate the tone for the remainder of the week. In summary, while the seasonal tailwinds favor bulls, the technical landscape demands respect. Balance your optimism with prudence, keeping a close eye on how SPY behaves at these critical levels. After all, trading isn't about predicting, it's about preparing. Bullish scenario: if SPY opens above 595.95, that would give us a potential buy trigger at an open above 595.95, which is the 20 EMA. This level aligns well with the day's high and would signify strength by breaking the rejection point established during Monday's session. However, the 61.8% Fibonacci retracement level near 596.37 of the last few days' price action adds a layer of complexity. The proximity of these two levels creates a potential area of confluence that could act as immediate resistance. If SPY can decisively break above this confluence zone early in the session and sustain it, it would likely trigger further momentum buying, potentially targeting the 600 to 604 range, where additional technical levels and psychological resistance come into play. On the other hand, a failure to hold above 595.95 or the Fibonacci level could invite selling pressure, bringing the lower pivot near 592.44 or even the critical 589 to 588.50 zone back into focus. Look for follow-through to 600 or 603, a level where overhead resistance from prior consolidation emerges. Use 595 as a mental stop for longs if the breakout fails. Bearish scenario. If SPY opens below and struggles to reclaim 595.95, look for a retest of 589 and potentially 580 on continued weakness. Your skepticism below 595.95 remains valid. Price needs to prove itself above this level. Key observations on QQQ. The QQQ has indeed closed above both the 10 and 20-day exponential moving averages, and this nuance is not to be understated. From my perspective, this technical event merits our close attention because it suggests a notable resilience in technology-heavy sectors, which historically lead broader market recoveries. Let's examine the implications further. The closing action above these moving averages not only establishes a short-term bullish bias, but also reinforces the notion that we may be witnessing a rotational leadership back into growth and tech. This, paired with the broader indices like SPY flirting with key resistance levels, potentially setting the stage for what some may call the Santa Claus rally. However, we must temper optimism with prudence here. The market's inability to hold above the 10 EMA on SPY, juxtaposed with QQQ's outperformance, creates a dichotomy that warrants deeper inquiry. Moreover, investor skepticism regarding SPY underperforming relative to QQQ is justified, especially as the S&P 500 rejected its 10 EMA today. Such price action reflects a lack of consensus among institutional players. A gap up tomorrow could trigger follow-through buying, especially if QQQ clears 525, which aligns with the next resistance zone. 530 to 535 could come into play if momentum accelerates, with 510 now acting as strong support. A gap fill scenario back to the 515 to 517 area is possible if today's rally was more short covering than sustained buying. Any failure to hold 515 would invalidate the bullish setup and warrant a more defensive posture. The tech leadership makes a strong case for optimism, and QQQ's position relative to the EMAs is a definite green flag. Let's take a look at the Dow Jones. The Dow Jones Industrial Average has been underperforming for a few reasons, rooted in sector dynamics and the index's composition. Let's explore why the Dow Jones Industrial Average might be lagging behind. When we observe capital rotating out of small caps, financials, and consumer staples and into technology, it often signals a shift in market sentiment. Small caps, represented here by the Russell 2000, tend to thrive in a risk-on environment when investors are optimistic about economic growth and willing to take on more speculative positions. A pullback in this sector, coupled with weakness in banks and consumer staples, suggests that market participants are adopting a more cautious approach. The underperformance of the Dow, compared to indices like the Nasdaq or even the broader S&P 500, largely stems from its unique composition and structure. Unlike the Nasdaq, which is heavily concentrated in high-growth technology names, the Dow is a price-weighted index. This means that the influence of each stock on the index is determined by its price, not its market capitalization. As a result, companies with higher share prices disproportionately sway the Dow's movement, irrespective of their actual size or overall market impact. Now, the simultaneous decline in Bitcoin and other cryptocurrencies further underscores this risk-off sentiment. Cryptocurrencies are often considered high beta assets, meaning they tend to perform well when risk appetite is high and markets are rallying broadly. Bitcoin testing $107,000 and subsequently dropping under $94,000 indicates that even speculative bets are being reevaluated. This suggests a more defensive posture among investors, possibly in anticipation of economic uncertainty or potential headwinds. Moreover, cyclical sectors like industrials and financials, key components of the Dow, tend to face headwinds during periods of economic uncertainty or when recession risks loom. These sectors are more sensitive to economic slowdowns, which can cause the Dow to lag, especially when investors are pivoting towards growth-oriented or defensive sectors. Lastly, there's a behavioral aspect to consider. The Dow is often perceived as a more traditional index, representing the old guard of corporate America. In a year when market narratives are dominated by themes like artificial intelligence, innovation, and rapid technological advances, it's no surprise that investor enthusiasm is gravitating towards indices that reflect those trends more robustly, like the Nasdaq or even the S&P 500 with its heavier tech weighting. In essence, the Dow's underperformance isn't necessarily a failure of the index, but rather a reflection of where investor priorities currently lie and the structural biases of the index itself. Transitioning to the weekly chart, the volume profile is intriguing. Last week's volume spike, coupled with a lower wick, does suggest exhaustion among sellers. It indicates that while sellers attempted to push prices lower, buyers stepped in, resulting in a recovery. This aligns with a potential reversal setup, though confirmation would require a strong close this week above the 10-week EMA at 595.83. Such a close would lend credence to the hypothesis that the 578 to 580 area served as a pivotal low, setting the stage for a continuation of the broader uptrend. However, the subdued nature of the rally relative to the recent selling wave suggests caution. This volume could also represent opportunistic profit-taking by short-term buyers rather than a sustained reversal by institutional players. The absence of a meaningful increase in buying volume adds a layer of uncertainty, especially as SPY approaches critical resistance. Heavy volume stands in stark contrast to the prior trend of lighter volume declines during pullbacks. The magnitude of last week's volume combined with the steep drop could indeed suggest profit-taking or institutional distribution rather than simply retail-level selling. This aligns with the theory that the market may be transitioning from a phase of impulsive buying, as we saw with the August 1st initiation bar, into a period of consolidation or, more concerningly, potential distribution. The heavy green bar from August was an initiation signal, indicative of aggressive institutional accumulation. By contrast, last week's red bar, especially after a significant uptrend, could signify institutions locking in gains or worse, reallocating capital elsewhere, perhaps away from equities. In my view, last week's volume and decline look more like a first salvo of heavier selling pressure following a long uptrend, which raises the probability of further downside or at least a lackluster recovery. Add to that the recent softness in cryptocurrencies like Bitcoin, and it becomes clear that market participants may be shifting away from speculative assets and equities alike. If institutions are indeed beginning to sell in size, this could act as a leading indicator for more pronounced downside. Remember, institutional selling doesn't always result in immediate steep drops. Rather, it can show up as heavy resistance at key levels, creating the appearance of consolidation while quietly distributing shares. From a technical perspective, the 595.95 level 20 EMA on SPY now becomes even more critical. If SPY cannot reclaim and hold above this level decisively, it would confirm that buyers lack conviction at higher prices. Moreover, the nearby 61.8% Fibonacci retracement at 596.37 adds weight to this resistance zone, potentially acting as a line in the sand for bulls. Should SPY fail to break through and sustain above these levels, we may see a retest of last week's lows around 578 to 580 or even deeper. Conversely, a strong close above the 20 EMA on renewed buying volume would weaken the bearish thesis and suggest that the market still has legs to push higher. Given the conflicting signals, last week's heavy red bar suggesting potential institutional selling juxtaposed against the seasonal Santa rally narrative, it's prudent to remain flexible. If you're looking for upside plays, waiting for a clear break, and close above 595.95 to 596.37 minimizes the risk of false breakouts. On the other hand, any significant rejection from these levels would favor a defensive posture, with eyes on the 588 to 589 pivot zone for short-term support. To summarize, my interpretation of last week's volume as an exhaustion of buyers rather than sellers introduces a cautious tone to the analysis. The weight of evidence suggests that while short-term, Santa, bounces are possible, the heavy selling last week could signify the start of a larger distribution phase. Watching how SPY interacts with the 20 EMA and Fibonacci resistance levels will be critical in assessing the market's next move. One last chart, a 5-day chart of Tesla. The narrowing Bollinger Bands provide a clear indication of reduced volatility, a coiled spring preparing for expansion. This compression often precedes significant moves, though the direction of the move depends on several intertwined factors. Today's high at 434.51 becomes the first critical benchmark. The after-hours trading above 435.65 as of this writing introduces optimism for a bullish continuation. Should Tesla manage to open above this level and sustain momentum, it might engage with the next resistance around 436. Beyond this, the next hurdle stands at the resistance level of 442.41, which aligns with prior resistance and carries psychological significance. Now, to contextualize further, the 200 moving average at 448 aligns closely with the 50% Fibonacci retracement from the recent swing high to swing low of the past 4 days. This level serves as a robust confluence zone, technically significant due to its role as a mean reversion target within this consolidation phase. A break above this area could potentially open the floodgates for further bullish exploration. The bearish counterpoint, risks below 430. However, the market rarely operates linearly. If Tesla fails to maintain its momentum above 434.51, or if profit-taking occurs at 436 or 442, the downside risk becomes critical to assess. The current consolidation near the 430 level has acted as a demand zone. A failure to hold this support could set the stage for a retest of lower pivots. Key levels to monitor in this scenario include 425. The lower Bollinger Band and prior session lows offer a logical near-term support. 410, a strong historical support zone, and the low from earlier price action, where buyers have previously defended Tesla's value. In summary, 434.51 is the immediate line in the sand. An open above, with follow-through volume, could shift the narrative toward testing 442.41 and eventually 448. Conversely, failing to hold 430 could lead to exploratory moves toward 425 or even 410. As ever, let the opening session dictate confirmation for either side of the trade. Currently, the price is hovering above the 20-day EMA at 401.85 and the 50-day SMA at 324.83, both critical moving averages. The sustained bullish trajectory leading up to this point underscores the strength of Tesla's recent uptrend. The MACD's bearish crossover doesn't necessarily negate the uptrend, but does warrant caution, especially if coupled with further bearish confirmation, such as a break below the 20-day EMA. The plan and an action. Bullish scenario. An open above 435.51 with strong volume could signal a move toward 442.41 and eventually 448. Traders may look for momentum to align with this scenario. Bearish scenario. A rejection near 434.51 or a failure to hold 430 could lead to a retracement toward 410 or the 20-day EMA. This would validate the bearish MACD crossover. Neutral positioning. If price remains range-bound near 430 or 434, patience is key. A breakout or breakdown will likely provide a clearer direction. I hope you've enjoyed watching Sora Trades this year. I enjoy sharing my thoughts with you. If you enjoyed our video, hit that like button and subscribe so you don't miss any of our videos. I wish you all a very Merry Christmas and a prosperous New Year.